In this video, we're going to recap how do we go and calculate the cost of equity or cost of capital, and specifically the discount rate that is going to be used to evaluate the cash flows, and the discount rate which is going to be used to find the present values of the cash flows. So we are concerned about R in this case, right? So in DCF valuations, one of the most important parameter that comes up is going to be what is the rate at which we are going to try and find out the present value of the series of cash flows that we are going to encounter. We have already done a large chunk of this calculation in one of our earlier courses. We're just going to do a quick recap on how do we find out the discount rate for a series of cash flows. Right, so the discount rate cash calculations are what are going to come here. Remember, there are two kinds of discount rates we are going to use. Whenever we are discounting a cash flow, the discounting rate in the cash flow is nothing but the expected return to the stakeholders. And which are the stakeholders? Whoever is getting money out of that cash flow is the stakeholder we are looking at. So if we are looking at, let's say, FCFE, or we are looking at the dividends, who's getting this money? The equity holders are getting this money. So if we are looking at dividends or FCFE, the discount rate is going to be the expected rate of return for the equity holders. This is called as the cost of equity, right? At the same time, if we are looking at FCFF, then cash flows to the firm holders, which is FCFF, will include both equity and debt. These are discounted at the average expected rate of return. How would you get the average expected rate of return? This would be some form of average between the equity and debt returns, or expected rate of returns. This is known as cost of capital. Now, what is the average that is used? The average that is used is the weighted average, which basically means what is the weight of equity and what is the weight of debt in the company. Weight of equity into cost of equity, weight of debt into cost of debt. There is a small adjustment here. Cost of debt is also adjusted for the post-tax cost of debt, because you get a tax benefit on cost of debt, correct? So those are the broader adjustments that you get when you're looking at what kind of discount rate calculations are going to be. We have already seen bulk of this in applied corporate finance. We are just going to do a quick recap on how do we arrive at, let's say, cost of equity and cost of capital for a country like India. Now, when you look at a country like India, the cost of equity is typically calculated using a model called capital asset pricing model, also known as CAPM, right? What do we mean by CAPM? CAPM basically says that the cost of equity or expected return from the equity holder is the sum of a risk-free rate plus the extra risk that you're getting in the market, or return you expect for taking the risk by investing in stock markets, scaled for a stock specific risk, which is called the beta, right? So the risk-free rate in the economy is the minimum you should get. For investing in anything other than that, let's say investing in the equity markets, you want an extra risk premium because you're taking a bigger risk by investing in risky assets. And then within the stock market, every individual stock will have its own risk, which is given by the beta. So you take these three parameters and you basically arrive at what is called as the cost of equity. So now these three parameters become important when you are evaluating the cost of equity. So let's look at them one by one. The risk-free rate. Remember, the risk-free rate has to be a rate which is default free, and it is also reinvestment risk free, right? Who's default free? Local currency government bond, right? Remember, local currency, Government of India. So I'll use the term GOI, Government of India bond. Why is local currency? because you can print the local currency. You cannot print uh, dollars. If, for example, we are looking at India, you cannot print dollars to arrive at a default free rate because India doesn't have the capacity to print dollars or the power to print dollars, right? So you're looking at local currency Government of India bond. And what do we mean by reinvestment risk? Remember, a bond is going to give a coupon, and you're discounting this plus coupon 2, and you're discounting this at 2, and so on and so forth. Now, the, the concept of the yield to maturity, the concept of the YTM is the same as that of the IRR, and you're assuming in IRR that there is reinvestment that is happening at the same rate of return. Now, that may not be true in real life. If you invest in a bond, you get cash flows, but you may or may not be reinvesting them, right? So we want to eliminate that. To eliminate that, we use what is called as a zero coupon bond, right? So zero coupon bond is kind of considered as the risk-free security. Typically, we take the longest possible tenure. We use a long-term bond and the one bond which is actively traded, right? So most commonly traded and available long-term bond which satisfies these two conditions is the 10-year zero coupon government bond, and the yield on that is basically considered as the risk-free rate. So risk-free rate is 10-year zero coupon GOI bond yield. Now this rate varies from points to points, and in India you could consider this rate is anywhere between 6.5% to 7.5% at this point of time, right? There are further adjustments. What are further adjustments? This should ideally be the risk-free rate, but then if this is the risk-free rate, then for this particular bond the rating should be AAA. But India's rating is not AAA. India's rating is BAA3, which basically means even in, and this is in INR, Indian rupees bonds, right? Which means we are rated lower medium grade. And this basically means there is some risk of India defaulting even on its rupee bond, right? So this particular understanding is what we are going to bring in terms of our calculations. So we try and find out if there is a AAA bond, what is the rating? What is the yield on that bond? If India's bond was AAA, what would have been the yield on that? How do we do that? We find out generally what are the bond spreads between countries. We find out what is the bond spread between, let's say, a AAA and a BAA3. What is the spread between these two? Now usually the spread is about 2.4 or 2.5% as per the table. If you look at this table is kind of a collated average default spread in basis points. 1 basis point is 0.01%. So you're looking at, if your AAA bond is rated at 5%, then your BAA3 would be rated at 7.44%. Why? 5% plus 244 basis points. So 5% plus 244 basis points, that's equal to plus 2.4% or 2.44%. That gives you 7.44%, right? So that's the default risk-free rate that you're trying to calculate using this. Now, in the market, we already have this rate available, whatever this rate is, right? So let's say this rate in India is today 6.6%, argument's sake. That's the Government of India bond yield that we calculate. This, remember, is for BAA3. So to convert it to AAA, I have to take 6.6% and subtract 2.4% from that to arrive at a 4.2% number, right? That would indeed be my risk-free rate. So in India at this point of time, we are looking at a risk-free rate of 6.6 minus 2.44, so approximately 4.5%. Now remember, there are small adjustments that happen here. When you're doing the modeling, you're looking at risk-free rate plus beta into RM minus RF. So if I use 6.6% here, then I also subtract 6.6% here from whatever is the expected market return, let's say 15%. And there is a beta, uh, right? Let's assume for now the beta is 1. If I use 4.5%, then I effectively do this. So in a nutshell, I'm going to add RF and I'm going to subtract RF. So it doesn't really matter significantly as to what RF I'm using unless this number, which is the beta, is really big. If beta is 1, then whatever value of RF I use, if beta is 1, this and this will cancel each other out, right? But if beta is 2, then it becomes important what rate we are using. The technically correct method is the second one. This is the correct method that we are going to use when we're going to evaluate companies, right? So that's the risk-free rate calculations. Let's move ahead to the equity risk premium. Remember, equity risk premium can be found by trying to find out what is the average return on markets and subtract the risk-free rates from that. But for emerging markets like India, you do not have extensive returns available. So what do? You typically take a base premium for a mature market, like let's say the US, and then you add India specific risk. What is the risk? What is the country risk premium? What is India specific risk? What is the risk that an equity holder will ask for investing in India, right? For investing in India. And remember, equity holder, right? So the base premium for US mature market or US market can be calculated, and this number is approximately equal to 4.8 to 5%. That's what data suggests. What is the base risk premium for equity markets? Obviously, this needs to be readjusted, and this depends on a variety of factors. Every year, this number could change, right? The country risk premium could be calculated using what is the country default spread, which is the bond spread for the country, right? Or bond spread, as in when we say bond spread, we're basically looking at what is the spread between uh, the GOI bond yield versus, let's say, we're looking at uh, the government of US bond yield. Why? Because they're considered, let's say, the safest instrument. So we can find out what is the difference between these two. But remember, this is the bond spread. This is the excess return you will ask for investing in bonds. We are looking for excess return you will ask for investing in Indian equities, not Indian bonds, right? So this should be higher. So you scale it up by using a factor called sigma equity divided by sigma country bond. In other words, standard deviation on the equities divided by standard deviation on the bonds or debt, right? Now, historically, what has been seen is that this number is approximately 1.5 for emerging markets. So to arrive at a number, what happens is country default spread we've already seen is about 2.4% multiplied by 1.5, so you get 3.6%. To this, you add the 3.6%. So effectively get a number between 8 to 8.5%, right? 5% plus 3.6%. How did we get 3.6? 2.4. Where did we get 2.4 from? This was the 2.4% number that we saw. That's the spread between a US bond and an Indian bond. So we got the 2.4% number, multiply by sigma equity by sigma debt, which is usually 1.5, and we get this value, which is the extra risk that someone would want to get compensated for when investing in Indian equity markets, right? So that's 3.6% as we look at it. Finally, we come to the beta. Beta is nothing but the slope of a linear regression between the stock returns and the market returns, right? What does it mean? If beta is 1.2, then if the market moves up 10%, the stock is expected to move up 12%. And if the market is going down 10%, then the stock is expected to go down 12%. In other words, this is the amount of times an asset's return will be that of the market returns, right? So that's what beta is. And we've seen how to calculate beta using linear regressions or using the function slope in Excel, right? So technically we're going to use this, and we have RF, we have beta, we have RM minus RF. We can arrive at what is called the cost of equity, right? Now, next we could go and find out what is the cost of debt. So how do we get cost of debt? Either the firms would have specified in the annual reports in the notes to account section under, let's say, long-term borrowings, and they would have specified what the long-term borrowings are, right? If the bonds are trading in the market, the YTM or yield to maturity can give us what is the expected cost of debt. If the bonds are not trading, we could look at the credit rating. Let's say the credit rating of a company is BBB, and compare the yield on similar rated bonds in the market. So what does a BBB bond trade in the market? What is the YTM on a BBB bond? If none of these are available, we could just divide the interest income by total loans. So if I take the interest and I divide it by the loans outstanding, that should basically give me the cost of debt in real life, correct? So I'm going to use one of these approaches, and most of the times it is useful to take this one because there are many loans that a firm has, so you don't know which loans to use. So either you find an average value in point 1 which is available, or in these you look at point 4, which is the calculation such as this, and you get the cost of debt for firms in India. If Government of India yield is 6.6% or somewhere, then obviously all firms will vary between 6.6% and maybe at the upper end somewhere between 12 to 13%. So that's the range you're looking at, 6.6 to 12%, in which most companies will have their cost of debt in India broadly. Right? There could be some which are higher than 12 as well, but broadly bulk of the firms would be between, let's say, 6 to 12% kind of interest rates. So now what do? You find the weight of equity. Remember, when you're finding the weight of equity, where you're using equity value of the firm and debt value of the firm, E and D, the weight of equity and the weight of debt are calculated based on the market values of equity and debt, not the book values from the balance sheet. Remember, we had discussed this as well. So weight of equity into cost of equity plus weight of debt into cost of debt multiplied by 1 minus the tax rate. That is what is going to give me the weighted average cost of capital, or the cost of capital, which is going to be used to discount the free cash flow to firm, right? Cost of equity was for free cash flow to equity. Cost of capital is for free cash flow to firm. That's what we are basically looking at, right? So let's try and do a quick whack calculation. Cost of equity is given as 17%. Cost of debt is given as 10%. Cost of debt into 1 minus tax rate is being given as 10 into 1 minus 30%, which is 7%, right? Is equals to 10% into 1 minus 30%. And weight of equity is essentially 30%. Weight of debt is 70%. So your WACC calculation is going to be 30% into 17% plus 70% into 7%. What's this? 30 into 17 will be 5.1%. 70 into 7 will be 4.9%. That gives you the answer as 10%. So that's your WACC calculation. Remember, we have to look at the market value of equity and the debt. Usually the market value of equity and market value of debt are similar. So debt we will take from the annual reports or the annual accounts. This is the market capitalization of the company, which is the total value of the equity shares in the market. And based on that, we will calculate the weight of equity and weight of debt, right? That's basically WACC calculation. That's the calculation of the discount rate whenever we are building a cash flow statement and doing a discounted cash flow valuations. This section was largely a recap of what we have already done in applied corporate finance. As we end this section, a couple of quick questions. Explain why the government bond yield is taken as the risk-free rate, and what would be the cost of capital of a firm where cost of equity is 16%, cost of debt is 11%, weight of equity is 70%, and weight of debt is 30%. Assume the tax rates to be 30%. Thank you.